many of you, probably means the only index you're really tracking is the sleep-to-coffee ratio.
Definitely a different kind of tracking.
Exactly. But for those who still want some clarity on yesterday's market moves, which were pretty pivotal, let's just get right into it. Welcome back to the Deep Dive.
Good to be here.
Today is Saturday, August 23rd, 2025, and we're bringing you the intelligence brief for yesterday, Friday, August 22nd, 2025.
And it was quite a Friday.
It really was. Our main focus today is, well, it's significant, Fed Chair Jerome Powell's Jackson Hole speech. It seemed to spark a huge rally across global risk assets.
The dramatic rally, yeah.
So we're going to unpack exactly what he said and maybe more importantly, what it means for, your portfolio and the whole economic picture moving forward.
Sounds good.
This update is powered by NextSight. They're a global intelligence and investigations firm that really goes beyond just collecting data. With their open source OSINT platform, SiteConnect, they transform raw signals into actual strategy and let clients tailor reports to their precise priorities.
That's incredibly useful.
Yeah, from market analytics to cross-border investigations, their work consistently operates on another level. You can learn more at www.next-site.com.
Right.
So our mission today, as always, is to cut through the noise, give you a shortcut to being well-informed, and highlight the most important nuggets from yesterday's financial activity.
Let's do it.
Okay, so let's unpack this. Friday was, well, a pretty dramatic day. We saw this broad relief rally sweep through the markets. What exactly was the catalyst for such a strong finish to the week, especially after, some recent choppiness?
Well, it's interesting. It wasn't just that Powell spoke, but how his message landed. That's what sparked this big relief rally.
Right.
The key driver was definitely Fed Chair Jerome Powell's address at Jackson Hole. He signaled a very distinct and I think crucial dovish tone.
Dovish, okay. How so?
He explicitly said that the balance of risks has shifted towards weaker labor markets.
Ah, okay. So moving away from just inflation focus.
Exactly. This wasn't just like a vague mention of softening data. It felt like a real pivot in the Fed's primary concern. They're moving from what felt like an inflation-first mandate for a long time
Right.
to a more balanced view that explicitly acknowledges, the downside risks to employment now.
That is a shift.
It's a subtle but, I think, profound shift. And that's what really unlocked the investor optimism yesterday.
Yeah.
The main takeaway for a lot of people in the market was that an initial rate cut, well, it could now be justified as early as September.
September, wow, that's soon.
Yeah. So this dovish stance from Powell, and you combine that with maybe some renewed, though still fragile hopes about progress in the Ukraine peace process. It just fueled investor optimism and pushed markets up pretty significantly. It honestly felt like a heavyweight was just lifted.
Yeah, you could almost feel it in the numbers. So that's definitely a dovish signal then, a big shift. Now, how did that translate into actual market action? Did we see like a uniform rally across the major U.S. indices, or were there differences in how investors interpreted this Powell pivot?
It was powerful and pretty broad, signaling a clear shift to risk-on sentiment, like you said.
Okay.
The Dow Jones, for instance, it jumped around 1.9%.
Wow.
Which is roughly 850 points. And that pushed it to a new record closing high.
A new record. Okay. That's a pretty clear signal.
Absolutely. Pretty undeniable vote of confidence.
Yeah.
And what's also telling is how the S&P 500 managed to snap that 5-day losing streak it was on.
Right. That needed breaking.
It did. It posted a solid 1.5% gain, showing just widespread relief. And the NASDAQ Composite, the tech-heavy index, wasn't left out either. It added roughly 1.9%.
So pretty much across the board gains.
Yeah, the market clearly read this as maybe not a guarantee, but a strong confirmation of a potential September rate cut. It's almost like the clouds parted for a moment.
But is it sustainable? I mean, that's the question, isn't it? A nearly 2% jump feels huge, but we've seen these bursts of optimism fade before.
That's precisely the million-dollar question, isn't it?
Yeah. How should our listeners balance this immediate euphoria with the fact that the Fed has shown it can stay hawkish if the data says so?
That's the critical nuance right there. The immediate reaction was, well, exuberant. But the market is essentially pricing in a high probability of a September cut, not a certainty.
Right. Data dependent still.
Always data dependent. Their forward guidance hasn't fundamentally changed in that respect. What we saw yesterday was really a strong unwind of those previous rate hike expectations, and that fueled these short-term gains.
Okay.
Whether it lasts, its sustainability, that's going to hinge on those upcoming data points we'll talk about later, especially inflation and labor market figures. They could either solidify this optimism or, well, challenge it pretty quickly.
Makes sense. For now, though, the market's celebrating what it sees as a pivot.
For now, yes, a perceived pivot.
Okay, so the big indices reacted strongly. But let's drill down a bit. What did this mean for the underlying sectors? Did certain industries feel this love from Powell more than others? And what does that tell us about where the market thinks things are heading?
Yeah, absolutely. While the rally was broad, digging in, you definitely saw a clear pattern emerge, especially in those rate-sensitive sectors.
Like housing.
Exactly.
Yeah.
Home builders, for example, just surged. The sector gained more than 5% overall.
Oh, 5%.
Yeah. Names like D.R. Horton, Lennar, Toll Brothers, all strong advances. And it wasn't just the builders themselves. Even building material suppliers like Builders First Source climbed a robust 8%.
8%, okay.
And Mohawk Industries, the flooring company, gained 7%. This surge isn't just about thinking mortgages might get cheaper.
Right.
It speaks to a deeper market belief, I think, that the Fed is now actively looking to ease the pressure on these highly interest rate sensitive sectors, maybe unlocking some of that pent-up demand in housing that's been, pretty frozen.
That makes sense. What else stood out?
Well, chipmakers also had a very good day. The PHLX Semiconductor Index, the SOX Index, rose nearly 3%.
Okay.
And within that, bellwethers like Intel, ON Semiconductor, Global Foundries, they rallied strongly, between 5 and 6% each.
So tech wasn't left out?
Not at all. And also travel stocks, particularly cruise operators like NCLH and CCL, they saw significant boosts too, adding around 7%. It tells you that sectors that traditionally benefit from lower borrowing costs, maybe increased consumer spending and improving outlook, they were definitely in favor yesterday.
Okay, and speaking of tech, what about the giants, the high-growth names we watch so closely, the ones that have been so sensitive to rate expectations? Did they bounce back too? Any specific stories there?
Oh, absolutely. The high-growth tech names, they rebounded sharply. Tesla, for one, really led the charge, surging over 6%.
6% for Tesla, okay.
Yeah. Alphabet and Amazon, they each added approximately 3%. Meta platforms rose around 2%, while NVIDIA and Broadcom tacked on about 1% each.
So pretty solid tech rebound.
Definitely. I mean, these are the companies whose valuations are often seen as more sensitive to those future earnings projections, right? So lower discount rates just make those future earnings look more attractive. A dovish Fed is generally a tailwind for them.
Makes sense. Anything else notable in tech?
Well, yeah, what's particularly interesting within the sector is this specific story with Intel. It jumped 5.5%.
Right, I saw that. What was behind that specifically?
That was driven by President Trump announcing that the U.S. government would purchase a 10% stake in the company.
Ah, okay. So a very company-specific catalyst, separate from the broader Powell sentiment.
Exactly, a unique factor boosting it. But, wasn't all positive news. Even with the rally, we're still in earnings season wrap-up. Intuit actually slumped 5% despite beating forecasts.
Oh, why was that?
Mostly due to weak guidance. It just shows that even in a broad rally, individual company performance and, crucially, their outlooks still really matter. And Workday also fell about 3% after its results. So it's a reminder that fundamentals are still very much in play.
Good point. Okay, so equities bounced powerfully. But when rate expectations shift this much, this quickly, we have to look at the other side of the coin, fixed income. How did bonds and the U.S. dollar react to all this?
That's a vital connection, absolutely. Because when rate expectations shift, fixed income markets react instantly, often with even greater sensitivity than equities.
So what did we see in treasuries?
We saw U.S. Treasury yields fall right across the curve. The 2-year note yield, which is very sensitive to near-term Fed policy expectations, it slipped significantly down to 3.79%.
Okay, quite a drop.
Yeah. And the crucial 10-year yield dropped notably, too, down to 4.26%. That's roughly 7 basis points lower than Thursday.
7 basis points, okay.
And even the long end, the 30-year yield, it dipped too, hovering near 4.92%, down about 0.04 percentage points.
So yields down across the board. What did that do to the yield curve shape?
Well, this collective move actually steepened the yield curve.
Steepened, okay. Explain that a bit.
So when we talk about 2s10s and 230s steepening, it means the spread, the difference between the shorter-term 2-year yield and the longer-term 10-year and 30-year yields widened.
Right.
And that often indicates a belief that while immediate policy might ease, so short-term rates fall, the longer-term economic outlook might be improving or at least normalizing, keeping longer rates slightly more anchored or falling less.
Interesting. And this ties back to Powell.
Directly. His acknowledgement of those increased downside risks to the labor market, and also his comment that tariffs are only temporarily boosting inflation. That gave investors the confidence that the Fed really will begin cutting rates next month, and that solidified the price action we saw in bonds.
Got it. And the
Yeah.
dollar, it's been quite strong lately. How did this dovish turn impact the U.S. dollar and other major currencies?
Yeah, with that big shift in rate expectations, the U.S. dollar weakened quite broadly, and pretty notably, too.
How much?
The DXY, the U.S. dollar index against a basket of other currencies, it fell almost 0.9% to about 97.75.
Almost a full percent. Okay, why the drop?
It's really because Powell's dovish comments effectively eroded those yield differentials we talked about.
Yeah, okay.
Essentially, if the market thinks the U.S. is going to cut rates, the extra yield you get for holding dollar assets compared to, say, euro or sterling assets, that diminishes.
Right, making the dollar less attractive, relatively speaking.
Precisely. So consequently, other major currencies firmed up against the dollar. The euro strengthened to about $1.16. So 1 euro equals US 1.1608.
Okay.
And both the Swiss franc and sterling also gained modestly. And an interesting detail here is that in the FX options market, bullish sentiment towards the dollar dropped to a 3-week low.
So traders are adjusting their positions based on this.
Reflecting these changed expectations, exactly. Investors are recalibrating their currency exposures. And that could have pretty big implications for multinational companies, trade flows, and so on.
Definitely something to watch. Okay, let's shift gears now. And I know for many of our listeners, this is an area of intense interest. Digital assets.
Yeah.
Did all this risk-on feeling spill over into the crypto markets? They can be pretty sensitive to broader sentiment.
Oh, it absolutely did spill over, and quite dramatically in some corners of the crypto market.
Really? How so?
Well, crypto markets rallied sharply as those rate cut hopes sort of revived overall risk appetite. Bitcoin, for example, it reclaimed the $114,000 USDT level. It posted a solid 0.36% daily gain.
Okay, solid but not explosive for Bitcoin.
Right, but the real standout yesterday was Ethereum. ETH surged over 14%.
14%.
Yeah, over 14% to approximately $4,810 USDT. That's its highest price since way back in 2021.
Wow, that's a huge move.
It was massive, so significant, in fact, that one prominent trader, known online as Machi Big Brother, reportedly pocketed over $4.7 million in profits just from that move.
Incredible. What about other coins?
BNB also gained about 6%, trading around $890 USDT. That seemed buoyed partly by some positive news that China Renaissance plans to invest $100 million to support BNB adoption, so a specific catalyst there too.
And any regulatory news, that always seems to move crypto.
Yeah, there were a couple of potentially positive developments. FENEC filed with the SEC to launch a staked Solana ETF focusing on JITO-SOL.
Interesting. Solana ETF.
And 21 shares registered an XRP ETF in Delaware. These kinds of filings are often seen by the market as signs of, increasing institutional acceptance and interest.
Building more bridges to traditional finance.
Exactly. But, and this is really crucial to stress, we also got a stark reminder of the persistent risks in this space.
Oh, what happened?
Interpol recently uncovered a massive $300 million crypto fraud scheme based in Zambia. It apparently affected about 65,000 victims.
Ooh, 300 million, that's huge.
It's a massive number. It just reminds everyone that despite the market optimism, despite the institutional interest, security issues, and fraud, remain major ongoing concerns. It's something every single investor in this space needs to be constantly, acutely aware of.
A very important counterpoint to the rally enthusiasm. Okay, let's turn back to traditional commodities, specifically crude oil and gold. How did they navigate this Powell pivot and the still simmering geopolitical situation?
Right. In crude oil, prices kind of steadied. Markets are still trying to weigh those geopolitical risks against demand concerns, which, might be eased a bit by potential rate cuts.
So where did prices end up?
Brent settled around $67.73 a barrel, WTI around $63.66. Both were up just slightly on the day.
Okay, what about the week overall?
Both contracts actually gained for the week. Brent was up about 2.9%, WTI up 1.4%.
What drove the weekly gain?
It seemed to be a combination of those fragile hopes for a Russia-Ukraine ceasefire, which tends to ease supply risk concerns.
Right.
And also a larger-than-expected drawdown in U.S. crude inventories, about 6 million barrels. That signals pretty robust demand still.
But the geopolitical situation is still tense, right?
Exceptionally high uncertainty there. Peace negotiations seem to have slowed. Russia targeted some infrastructure near the EU border. Ukraine apparently struck a Russian refinery and an oil pumping station.
Okay, so still very active.
Yeah. And there's even talk of a potential suspension of Russian oil flows through the Druzhba pipeline to Hungary and Slovakia for about 5 days. That adds immediate supply risk. So you had some positive demand signals and hopes for de-escalation, but the supply side risks. still very much in play, creating a volatile mix for energy prices.
Understood. And gold, how did the yellow metal react?
Gold did well. It rose a solid 1.1% to $3,415 an ounce,
Why the rise?
primarily due to those falling Treasury yields and the weakening dollar we discussed.
Right, the usual drivers for gold.
Exactly. Lower yields reduce the opportunity cost of holding non-yielding gold, and a weaker dollar makes gold cheaper for buyers using other currencies. It bolstered its safe haven appeal in this environment.
Okay, this has been a really dynamic day, a lot to process. So, pulling it all together, what does this mean for you, the listener, as you look ahead to the coming week? What should people be keeping a really close eye on to understand if this rally might actually have legs?
Yeah, connecting it all to the bigger picture. That fragility of the Ukraine peace process is definitely number one to watch very closely.
Okay.
Those negotiations are so delicate. Any significant shifts there, positive or negative, could trigger really sharp, unpredictable moves, especially in energy and currency markets. And that could easily spill over into broader risk sentiment.
Right, a key uncertainty. What about data?
Beyond that, there's a slate of key upcoming U.S. data points. These will be absolutely critical for informing the Fed's next moves and validating or refuting this market optimism.
What should we be watching for specifically?
Okay, so on August 26, Tuesday, we get U.S. durable goods orders for July. That's a key gauge of business investment, future economic activity.
Got it.
Then August 27th brings U.S. consumer confidence data, tells us about the health of the consumer, which, drives so much of the U.S. economy.
Crucial.
And then the big one, August 28th, Thursday. We get the U.S. Personal Income and Outlays Report. That includes the core PCE price index.
The Fed's preferred inflation gauge.
That's the one. That's the number the Fed watches most closely for inflation trends. Same day, there's also a U.S. two-year note auction, which will give us a fresh read on bond market demand and rate expectations right after the PCE data.
Lots packed into Thursday.
Yeah. And globally, keep an eye out for Eurozone flash CPI, China's official PMIs, and the usual EIA weekly petroleum status report.
So even with Powell's pivot.
Exactly. Even with the perceived pivot, remember, we're still in, thin summer liquidity conditions. And there are lingering inflation pressures like those tariffs Powell himself mentioned. It means volatility could return really quickly. Expect markets to kind of oscillate around these policy expectations based on the incoming data.
So for our listeners.
For you listening, these upcoming data points are going to be absolutely crucial in gauging whether the Fed can actually deliver that September rate cut the market's now pricing in. And of course, how that might impact your own financial planning and investment decisions.
Okay, thinking big picture then. Given Friday's, seismic moves, what are some of the actionable insights maybe for different types of market participants? How should they be adjusting strategies right now?
Yeah, this Powell pivot or perceived pivot, it really demands a fresh look across the board strategically.
For instance, for CIOs.
For chief investment officers, it fundamentally changes the asset allocation calculus, right? With Treasury yields falling and the potential for more cuts, maybe extending duration now could capture significant capital appreciation.
Something that was off the table for a while.
Exactly. A strategy that was largely unattractive for much of the last year or two. They'll also be reassessing that growth versus value allocation again, because lower rates typically favor those duration-sensitive growth stocks like tech, maybe housing.
And for Treasury desks.
Treasury desks need to monitor that yield curve steepening really closely. It impacts their cost of funding, their liquidity management. They'll be evaluating whether maybe now's the time to lock in longer-term funding at these potentially lower rates.
Makes sense. Risk managers.
For risk managers, well, that lingering geopolitical risk in Ukraine, despite the peace hopes, that remains a top concern. Energy prices could still surge on renewed conflict, so you need robust contingency plans for potential supply disruptions.
And on the crypto side.
Yeah, on the crypto front, while the market rallied, that huge Interpol fraud scheme is just a stark reminder. Cybersecurity risks, illicit activities, they are persistent threats. It requires continuous monitoring, especially for firms dealing directly with digital assets.
Right. And finally, CFOs.
For CFOs, that weakening dollar we saw has potentially significant implications. If the trend continues, it could boost the translated revenues for U.S. companies with big overseas sales, but it could also impact import costs. So they'll definitely be evaluating and potentially adjusting their currency hedging strategies to navigate this new dollar environment.
Lots of strategic recalibration happening then.
Okay, that wraps up our deep dive into the Friday, August 22nd, 2025 intelligence brief delivered to you on this Saturday, August 23rd. It was Certainly a memorable end to the trading week.
Definitely one for the books, driven largely by that Powell shift.
Yeah, that perceived dovish shift and the market's, well, enthusiastic response. Now, if you're looking for intelligence that doesn't just keep up but keeps you ahead, Nextsight delivers. They support executives, analysts, and investigators worldwide with insights that are not only reliable but immediately actionable. You can visit www.next-site.com to learn more. Yeah, today really showed how swiftly market sentiment can just pivot on central bank guidance and, geopolitical news whispers. Wow. That relief rally was broad, it was powerful, but as we've discussed, the road ahead, still paved with significant data points, complex geopolitics, and lingering risks that are absolutely going to test this newfound optimism.
Absolutely. So here's maybe a provocative thought for you to mull over this weekend. Could this Powell pivot truly anchor risk sentiment long-term? Could it fundamentally shift the market's entire frame of reference for monetary policy? Or are we just seeing a temporary reprieve, a sugar rush before inflation pressures or geopolitical risks inevitably resurface and challenge this whole wave of optimism?
That's the key question for the months ahead.
It really is. Don't forget to subscribe on YouTube and Spotify, and maybe drop us a like, share, or a comment. We'd genuinely love to hear your perspective on this market shift. May your Saturday be considerably more relaxing than the bond market was yesterday.
Definitely. Enjoy the weekend.
We'll be back tomorrow with another deep dive.